welcome to the deep dive. Today we're tackling asset allocation, trying to cut through some of the jargon.
Yeah, absolutely. We've looked at the essentials, the key questions really.
But goal is just a clear picture, right? Understand this core idea without getting totally lost.
Exactly. Think of it like, getting the blueprint right before you start building your investment house. Keep it focused.
Okay, good analogy. So let's start right there. What is asset allocation fundamentally, and why all the fuss? Why is it so important?
Well, put simply, it's just how you slice up your investment pie. How much goes into stocks, how much into bonds, maybe some cash.
Slicing the pie.
Well, that's important. It really boils down to being one of the biggest factors in your long-term returns and, crucially, how you manage risk. It's the big picture strategy.
Right. So less about finding that one magic stock.
Much less, yeah. More about the overall structure.
And more about deciding, say, 60% here, 30% there, 10% somewhere else.
Yeah.
Okay. So when you're making those decisions, what are the main things you need to consider?
Two big ones jump out immediately. Your age and your tolerance for risk.
Okay. Age and risk tolerance. How do they play in?
Well, generally, if you're younger, you've got a longer time horizon, right? So you might feel more comfortable taking on more risk, maybe allocating more to stocks for potentially higher growth.
Because you have time to recover from dips, potentially.
Exactly. Whereas someone closer to retirement, they might want more stability, maybe lean more towards bonds.
Makes sense. And the risk tolerance part?
That's more personal. It's about your gut feeling, really.
Yeah.
How much sleep would you lose if the market dropped 20%? That comfort level, or lack thereof, heavily guides your allocation.
Right. How bumpy of a ride can you handle? Okay.
Yeah.
You mentioned stocks, bonds, cash. Can we just quickly pin those down?
Sure. Stocks, that's basically owning a piece of a company. Growth potential, but, more volatile.
Okay.
Bonds are more like IOUs. You're lending money, usually to a government or a company, generally safer, lower returns typically.
Got it. Loans.
And cash or cash equivalents, think money market funds, savings accounts, that's your safe, easily accessible money. Very low risk, very low return usually.
Okay, clear enough. Now, diversification, that word comes up constantly.
Yeah.
How does spreading money across these different types actually, reduce the risk?
Yeah, it's interesting because these different asset classes often don't move in perfect sync. When stocks are down, sometimes bonds might be holding steady or even up and vice versa.
Ah, okay. They react differently.
Precisely. So by holding a mix, diversifying, you're not betting everything on one horse. The aim is to smooth out the overall ups and downs of your portfolio. Less dramatic swings.
So it dampens the volatility, not necessarily about maximizing every single upswing, but protecting on the downswing too.
That's a great way to put it, aiming for more consistent progress.
Okay. Now, I've heard terms like strategic and tactical asset allocation. What's the difference there? Sounds a bit jargony.
It can sound that way, yeah. Think of strategic as your baseline, your long-term ideal mix based on your goals, your risk tolerance, the things we just talked about. It's your home base.
The main plan.
Exactly. Tactical, on the other hand, is about making shorter-term shifts away from that strategic mix.
Yeah.
Maybe you think bonds look particularly attractive right now, or stocks seem overvalued, so you temporarily adjust.
Okay. So strategic is the destination. Tactical is maybe taking a slight detour based on current road conditions.
Perfect analogy. Yeah. Strategic is the map. Tactical is adjusting for traffic jams or, a scenic route opportunity.
Got it. So if you have this strategic plan, this target mix, things drift, right? Investments grow differently. How do you keep it on track? That's rebalancing.
That's exactly rebalancing. Over time, maybe your stocks did really well, and now they're a bigger slice of the pie than you originally intended.
Right. It throws the percentages off.
Yeah. So rebalancing is just selling a bit of what's overgrown and buying more of what's lagging to get back to your target percentages. Keeps your risk level where you want it.
How often should you do that? Is there a rule?
That's debated. Some say annually, some say when things drift by a certain percentage, like 5%. There's no single magic answer, but reviewing it periodically, maybe once a year, is generally a good idea.
Okay. And for people who find all this tracking and adjusting a bit much, there are things like target date funds, right? How do they fit in?
Right. Target date funds basically do the strategic allocation and the rebalancing for you automatically.
Oh, okay.
You pick a fund based on roughly when you expect to retire, say a 2050 fund. It starts out more aggressive, heavier on stocks, and then automatically gets more conservative, shifting towards bonds as you get closer to that 2050 date.
So a set it and sort of forget it option, at least for the allocation part.
Pretty much, yeah. Designed for simplicity.
Okay. What about just plain old cash? holding some actual cash or equivalents in the portfolio. Why do that if it barely grows?
Well, cash gives you liquidity, money you can get your hands on quickly for emergencies or opportunities.
Right, easily accessible.
And it's safe. It acts as a buffer, a stability anchor, especially when markets get choppy. It won't give you big returns, but it provides that safety net and flexibility.
Okay, that makes sense. So we've covered the pieces: stocks, bonds, cash, diversification, rebalancing. How does someone actually figure out the right mix for them?
Yeah, that's the million-dollar question, isn't it? And the answer is it's totally personal. There's no single right allocation for everyone.
Depends.
It completely depends on your specific financial goals. What are you saving for? Your time horizon? When do you need the money? And circling back, your individual comfort level with risk.
So you really have to know yourself as an investor.
You do. And there are tools, questionnaires online or through advisors that can help you think through those factors.
And technology can help automate some of this now, too.
Absolutely. Beyond just target date funds, you have robo-advisors and other platforms that can build and manage a diversified portfolio for you based on the profile you provide. It takes a lot of the manual work out.
Okay, so wrapping this up, the core idea, the main takeaway, seems to be that asset allocation, deciding how to divide your investments, is just fundamental. It's your main lever for managing risk and working towards your goals.
That's the heart of it, yes. It's about being deliberate about where your money is and why.
Okay, so here's a final thought for you listening. So we talked a lot about risk tolerance, but maybe take a second to think honestly about your gut reaction to market swings. How much volatility can you genuinely live with day to day? And how might that feeling shape the asset mix that truly lets you sleep at night while still reaching your financial destination? Something to consider. Thanks for joining us on The Deep Dive.